Hello guys, welcome once again to yet another YouTube video from the Let's Trade community. Today we are going to be talking about synthetic indices, and what we are going to be talking on is the best way to manage risk in synthetic indices and earn consistent rewards. But before we continue, kindly do this community a favor by smashing the subscribe button, turn on post notification so that we can feel encouraged to keep making this type of videos for you guys. Now back to business. Now in synthetic indices, if you trade synthetic indices, you will know that there is a disparity in the lot sizes that you are allowed to use across the synthetic pairs. As you know, we have different synthetic indices. We have the volatility 75, we have the volatility 100, we have the volatility 10 and volatility 25. We have the step index, and the list goes on and on. But if you trade these synthetic indices, you must have noticed that they actually choose the least lot size that you can use, unlike forex where you can use 0.01 if you have a limited capital across all the currency pairs. But synthetic indices don't work like that. You have to use the least lot size that they are asking of you, which, if you ask me, it's not fair. But this posed a big problem to me when I first started off, and thank God today I've been able to conquer that, and I've kept my risks in a consistent level that makes me earn consistent reward by doing so. Now let's say you place 5 trades in synthetic indices. Let's say you place 5 trades in synthetic indices, and let me scroll up. Let's say you place 5 trades in synthetic indices, and you won 3 and you lost 2 with a 1:2 risk to reward ratio. And let's say the pairs you actually traded were let's say, for example, you traded VIX 70S, the jump 10, the VIX 50, the VIX 70, and the VIX 50S. And let's say you won the VIX 70S, you won the jump 10, and you won the VIX 50. And let's say you lost VIX 70 and VIX 50S. You will know that you will be underwater. Even if you traded the 1:2 risk to reward ratio, you will still be in a loss. Why? Because the volatility in these pairs are different. VIX 71S, jump 10, and VIX 50 are nowhere near the volatility of VIX 70 and VIX 51S. So even if you had used a 1:2 risk to reward ratio, yes, you've won 3 trades. Yes, you lost only 2. Why am I still in a loss? Is because of your inability to calculate your risk in synthetic indices. Now let's continue. How do you tackle these kind of problems? Now, I must tell you that when I first started out, this also posed as a serious challenge for me. I discovered that I win more of my trades and lose less, but yet I struggle to be in profit. At most, or at worst, I always break even, or I close the months in a red. And this is not fair if you ask me, and that is why we are making this video. At least if you are a beginner and you still have this kind of struggles, you don't have to struggle anymore if you watch this video to the end. Now I'm going to talk about 3 steps which you can use to tackle this kind of challenges. And number 1 is risk same amount of money across board. Now this requires a minimum amount of capital. You have to have some kind of minimum amount of capital to do this, because you can't actually do this with $100 as capital. Because if you ask me, it's not safe to trade VIX 75 or VIX 51S with $100 capital is going to burn you, if you ask me, except if you have some kind of a sniper entry, like you're a master of your own entry. Maybe that might work. But if you use a 4 hour entry candlestick like I do, and I also wait for you also wait for confirmation like I do, you will discover that you can't trade this number one step with $100 capital, not even a $200 capital. So that's why I will recommend a $400 capital minimum, or 500 to $1,000 and above. Now, number one step is what I practice myself. I started off with a $500 account because I take synthetic indices as a side hustle. My major investment is in forex, but of course we need gas fee, we need to pay bills and all. So I use synthetic indices to solve all those problems. Now, what I did was I invested $500, and I started taking trades, and I was risking 5% of my account, and if 5% of $500 is $25, right? So I was risking $25 per trade, so which means I was risking $25 for a 70 sorry for a $50 reward, right? Because I mostly use 2-to-1 risk to reward ratio, except maybe I see a bigger projection ahead and I decide to trail my stop loss. But that's not what this YouTube video is all about. Now, that was what I did, and I built my account from 500 to $1,000. So I used $1,000 as my threshold, and I started risking $50 for $100 profit. You understand? Using 2-to-1 risk to reward ratio. So I risk $50 per trade, and I am consistent with that. So even if I enter a trade, how you do that is, how do you even determine your stop loss that way? You open a demo account. Since we don't have position size calculator on synthetic indices, of course we have position size calculator for forex, but I've not found any. Correct me if I'm wrong. If there is, please leave a comment down below so that I can also learn from you guys. Remember, this is a community. So how I determine my stop loss and my profit target is, I have a demo account, so all I need to do is to go place a trade, then I place my stop loss. Okay, let me show you. I didn't want this video to be too lengthy, but I still have to make it as practical as possible so that you guys can understand what I'm saying. Okay, I have one open trade on volatility 51s. So now I placed this trade on the 4-hour time frame. Oh, sorry. I placed this trade on the 4-hour time frame. I actually was trailing this trade from this point, but I missed my entry around there. So when we broke below this trend line, I took my trade. Now if you look at this, I placed my stop loss above here. Of course I entered a little bit late, so my risk now is $60, which I can always adjust anytime I like. But this is how you determine your stop loss value in dollars. So once you place your stop loss at your desired location, you hover your mouse around it. Once you see your stop loss in dollars, that way you know, okay, all is set and you are good to go. So if it's bigger, what I do is I close the trade, or except I have extra faith in that trade, so I might decide to hold, just like in this case that I'm risking $60, because you guys can say, okay, I was talking about risking just $50, so why are you guys seeing $60 here? Why? Is because I have so much faith in this trade. If you look at this, this is a head and shoulder on the daily time frame. So I'm expecting this trade to push all the way down to the downside here, at least around here, but I'm taking my profit before we get there, just to be on the safer side. So my plan is, okay, when we move significantly into profit, I'm going to like minimize my risk. But anyways, I risk $50 per trade, as you can see, for a $1,000 investment, which means I risk 5% per trade. So that's number one step of how you can manage your risk. But like I said, it requires big capital. Now, without talking too much, let's go to step number two. Step number two, which is this. Sorry. Okay, which is this. Step number two is reduce lot size after placing a trade on heavy synthetic indices pair. Reduce lot size after placing a trade on heavy synthetic indices pair. Now, as many of you might not know, that you can actually reduce your risk even when you must have opened the trade. It works for both forex and of course synthetic indices. Now we're talking about synthetic indices, so I'm going to stick with synthetic indices. If you want a broader explanation on that, maybe on forex, I can make an updated video. Just let me know in the comment section below. Now, to reduce your lot size after placing a trade so you can manage your risk in synthetic indices, all you need to do is this. You won't know when you come here. I mean, you can determine the least lot size permitted per index on synthetic indices. So what I do to bridge this gap is to come here. Now this is boom 300, as you guys can see here. Excuse me. Now you can see 0.01 is not permitted on the boom 300, which is supposed to be the least lot size in forex, if you ask me. But no, synthetic indices is not giving us that option. In fact, they're actually deciding for us. All right, so we have to be smart so that we can manage our capital effectively. Now let's choose a higher lot size. I mean, let's see what boom is offering us as the least lot size usable to trade it. Now as you can see, this is 0.01. if I go below that, look around this place, you see the sell or the buy icon has disappeared, but once I hit 1, you see it has appeared, which means this is the least lot size that we are permitted to use. Now if you place your trade, if you place a trade on this boom 300 using this lot size, depending on your capital, maybe you have a capital of like say $50, and let's say the trade goes against you, you know, you might lose your capital, and we don't want that to happen, right? So what do you do? First of all, if you've decided that okay, you want to actually use a 0.01 lot size on this trade, all you need to do is add that one here like this. Are you getting it? Remember, the least lot size tradable with boom 1000 from synthetic index from deriv is 0.01. if I go below, you see that the icon here has disappeared. If I make it 0.1, you can see that it has reappeared. So now you want to actually trade 0.01 on this index, just add that one behind the first one, right? Now you go ahead and do what? Place your trade. Now as you can see, we are in, right? Ideally you should let this trade run, but remember, you don't want to risk that much lot size because you have a limited capital, right? Now what do? You come to price here, but before we do that, let's place our stop loss. Let's say okay, to be on the safe side, we want to put our stop loss right below this trend line that price just broke out from. Let's say okay, we have 38.32 as our stop loss. 38.32 looking, let's say 38.46. all right, let's say 38.46. excuse me. All right, now we hover our mouse, you can see our stop loss value is minus $27. That's huge if you're actually trading a $50 account, or if you're actually trading a $100 account. If you ask me, that's actually huge. Now, what you need to do, make sure that, okay, you must have analyzed the market, and at least to the best of your knowledge, you are trading a high probability setup, and you're confident that the market is going to rally to the upside in this boom 300 scenario right now. Now, all you need to do is to wait to get into a little bit of profit, right? Then all you need to do is come to price here, double click. Now reduce your lot size. Remember, now we are back to the 0.1 lot size permissible to trade boom 300 from there. If you go below that, this icon below here is going to disappear. Now I'm just going to put the 1. Remember, we entered this trade with 0.11, right? Now we're going to close 0.1 like this. But like I said, I want to emphasize on this because it's very, very important. Make sure you go into profit, into little profit before you do this, because right now I'm going to close this. It's going to close me in a loss, right? I actually didn't have planned to trade this, but just for illustrative purpose, that's why I'm doing this right now. So wait for it to go into profit before it closes, because if I close now, it's going to close me in a minimal loss. But I'm just going to go ahead and close anyways, because I'm not interested in trading this pair. Now we are closing 0.1 close. So you see our trade is still open, right? But now we are trading 0.01. Now that's how you can reduce your loss, lot size on a trade that you've already triggered. And I think this is going to help you manage your risk properly also. Now let's go back to this. Number 3 step to actually manage your risk in synthetic indices is trade only pairs with almost the same volatility. If you ask me, this is the easiest among the 3 steps. Trade only pairs with almost the same volatility, and examples of such pairs are VIX 10, Jump 10, VIX 71S. VIX 71S is the least pair, the pair with the least volatility in synthetic indices. Then you can also trade Jump 25, VIX 25, and there are other few pairs that you can trade like that. If you actually trade synthetic indices, I know you know these pairs, you can trade. With this, we've come to an end of today's class. If this video was helpful to you, kindly help us smash the subscribe button, turn on post notification. You can also comment so that we can engage the community, and also share this video with your friends.